Norman Hallett here with your next 4-minute drill for traders. Let's continue on our capital preservation rampage by hitting a couple more points. I may have to say this point twice because it's counterintuitive. The more active a trader you are, the less you should risk per trade. And I'll say it again. The more active a trader you are, the less you should risk per trade. Now, obviously, if you're making dozens of trades a day, you can't afford to risk even 2% per trade because one really bad day could virtually wipe you out. Longer-term traders who may make 3 or 4 trades a year could risk more, say 3, 4, 5% per trade. For me, if I have a good start to my trading day, I've learned not to turn up the heat and take on bigger positions while I'm on a roll. In fact, I do just the opposite. I go into more of a defensive posture, taking on less risk for the rest of the day and demanding that I only take very high probability trades at the end of the day. If you find yourself wanting to turn up the risk, if you get off to a good start in your trading day, you may want to check yourself and see if you're not treating your early profit money as profit. You don't want to do that. And make it somehow okay to lose back because it's just profit. So you're willing to take some bigger chances to parlay your early success for the day. I'd much rather you defend early winnings and see that early profit immediately as part of your core capital and defend it as such and move forward for the rest of the day in an orderly fashion. And by the way, regardless of how active you are, make sure you limit your total portfolio risk to 8%. And speaking of core capital, this is a good time to make an important point. Make sure you're adequately capitalized. There's no holy grail in trading. However, if there were a holy grail, I think it would be having enough money to trade and taking small risks. That would be the holy grail combination. These principles have you survive long enough to prosper. I know many successful traders who wiped out small accounts early in their careers, and it was only until they became adequately capitalized and took reasonable risks that they survived, then prospered as long-term traders. The larger account you start off with, the easier it is to find low percentage risk trades. I'm talking about percentage of your total equity. And by keeping risk very low, you can stay relaxed so that you can be there for the big gains when they come. So to sum it up for today, the more active a trader you are, the less risk you should take per trade. And remember that in order to be successful long term, you must be adequately capitalized. It's much easier to succeed as a trader with a $50,000 account than a trader with a $5,000 account because it's easier to keep your risk percentage low the bigger the account is that you're trading. Okay, that's it for this edition of 4-Minute Drill for Traders. So until next week, say it with me, stay disciplined.